Many people understand compound growth in theory, yet very few truly feel its impact. A small increase today often looks insignificant, almost invisible against the backdrop of daily expenses and short-term goals. Because the human brain evolved to prioritize immediate rewards, it tends to underestimate changes that unfold gradually over years rather than days. This creates one of the most common blind spots in personal finance: the tendency to underestimate compound growth. Imagine two people starting with the same amount of money. One focuses only on increasing contributions whenever possible, while the other delays action because the amounts seem too small to matter. In the beginning, there appears to be almost no difference between them. The gap is so small that it feels irrational to care about it. Yet compound growth does not operate according to intuition. It operates according to mathematics. The reason is simple. Most people think growth is linear. If something increases by a fixed amount each year, the path is predictable. Compound growth follows a different pattern because each period builds not only on the original amount but also on previous gains. Growth begins generating growth. What starts as a tiny advantage gradually becomes a larger base, which then accelerates future increases. Consider a simple example. If $1,000 grows by 10%, it becomes $1,100. Another 10% increase does not add another $100. It adds $110 because growth now applies to the larger amount. The following year it adds even more. The percentage remains the same, but the dollar increase becomes larger because the base keeps expanding. This sounds obvious when written on paper, yet our minds rarely process it naturally. Behavioral economists have found that people consistently underestimate exponential patterns when asked to predict outcomes involving compounding processes. Many individuals expect steady progress rather than accelerating progress. The result is a systematic misunderstanding of how wealth accumulates over long periods. This misunderstanding affects financial decisions in subtle ways. People often focus heavily on finding the perfect investment while paying less attention to time. Yet time is one of the most powerful variables in any compounding equation. An investment growing for 30 years can produce dramatically different results from the same investment growing for 20 years, even if the rate of return remains unchanged. A useful way to think about compound growth is to imagine planting a tree. During the first years, progress seems disappointing. The tree remains small, and each year looks similar to the last. But beneath the surface, roots expand and the foundation strengthens. As the tree matures, growth becomes more visible because it is building upon everything that came before. Wealth often follows a similar pattern. From a broader economic perspective, compounding explains why small advantages can produce large differences over time. Whether examining personal savings, business growth, national economies, or technological progress, the same mathematical principle appears repeatedly. Tiny improvements sustained consistently can create outcomes that seem disproportionate to the initial effort. The psychological challenge is that compound growth rewards patience more than intensity. Humans naturally notice dramatic changes, while compounding usually begins quietly. For years, the results may appear unimpressive, which tempts people to abandon the process before the mathematics has time to work. Yet the later stages often depend entirely on those earlier, seemingly insignificant years. Understanding compound growth is therefore less about learning a formula and more about recognizing a pattern. The greatest mistake is not failing to understand the math. It is expecting the math to look impressive too early. The power of compounding is that its most important years often arrive long after most people would have given up watching.